or inside the portfolio if you're tracking in positions, but how to use the position analysis tools to roll a long collar position. Long collar, of course, where I buy stock, sell an at or out of the money call, and buy an out of the money put with the same expiration, what I call a standard collar, not a dynamic collar. And Paul goes on to say, if I have a long collar and the underlying stock is increased so that my call is in the money, how would I use your tools to analyze how far out and what strike should I roll to? Okay, should I leave my put in place until expiration or roll it to? Okay, well, that's something different, a little bit different, but I'll get to that too, I'm sorry. And then if I have a long collar, my underlying stock has decreased, my put is still out of the money, how would I analyze a roll? Okay, now, there are three concepts here. Standard collar, this is your profit and loss chart, looks very similar to a bull put credit spread or a bull call debit spread. But it involves buying stock. So in this case, may have bought stock at around 51.30 or so. So we own the stock, and I might have sold a 51.50 call and bought a 49.50 put. So if I was wrong and the stock collapsed, I have a very limited risk on the position. If the stock moves up, I get assigned at the call, my put expires worthless, and we receive the maximum profit. And if it's between, whether you're at expiration or still timed to expiration, well, then you may be able to buy your call back more cheaply and roll it down or roll it for a different strike, or you may be able to adjust the put depending on the scenario. If you're at expiration, both the call and the put expire worthless, you want to decide if we liquidate the position if we're at a profit, or maybe re-bracket the collar for the next expiration, 1 week out or 2 weeks out, whatever it is, depending on your goals and what you're looking to accomplish. Now, I entered 3 collars to look at in the portfolio that expire this week. Okay, it doesn't address one of Paul's situations, but we'll take a look at that too, where we still have time to go to expiration, the stock has fallen. 3 collars for today's expiration though. AMAT is now above the strike and at maximum profit. VXX, collar opened on Monday, would be below the put strike price and would be at the maximum loss. And Sony, SNE, which we just sort of looked at on the profit and loss chart, little graph I threw up there, that's the one that's between the strike. The put is still out of the money, but it's also at expiration. All right, so let's navigate over to the PowerOptions suite of tools. Okay, let's see here. There we go. And sorry, there we go. And I'm going to go right into the portfolio. Okay, so am I looking at the right screen? No, I'm not. Hold on, folks. This is going to be much better. Now we're looking at the right screen. I'm on the PowerOptions tools here on our webinar account. I'll go right to my portfolio, and then we're going to click on portfolios to see our 3 collar positions. Now, as I mentioned, AMAT is the one that has moved up above the short call strike price. Let's go to the position analysis tool. This is what Paul was asking. How would I manage this position? Or how would I use the tools to help me manage the position? Anytime you're tracking a position that's listed as a collar, covered call, naked put, bull put credit, or married put, anything that's classified as our 23 common strategies, you'll be able to link to the Position and Actions tab and then go to Position Analysis. The Position Analysis tool gives us a breakdown of our existing position. This position would have been opened on Monday, where we would have bought AMAT at $59.95, sold the March 60 call, today's expiration 60 call for 80 cents, and bought the 58 put for 20 cents. We got a 60-cent positive premium at the 60 strike, and the purchase of the stock was $59.95. So the max gain was 65 cents, the max loss was 135, about a 2-to-1 ratio. You should look for a little bit better, but in this case we'll just go with it for the example. Now, AMAT closed today at 61.60, $1.60 in the money. We're going to be assigned potentially today. Before expiration, 2, 3 o'clock, I would have looked at the position analysis for our position and saying, okay, right now if I get assigned, I'll make about 1.1% on the position, or I could have liquidated for about the same 1.1%, getting closer to expiration. liquidation in this case would be selling to close the stock, buying to close the short call, and selling to close the put, although we'd only get 3 to 5 cents, for example, in that. Okay? Now, as I scroll down below, remember we're at March 9th expiration, it shows me opportunities for rolling out the call to avoid assignment. So I see here I could roll out to the 16 March 62 strike to get 84 cents. Now I was going to have to pay $1.62 to buy to close the existing option. And we only took in 80 cents up front. We could get 84 cents here. So this is rolling for only a 2-cent net credit, isn't it? Right? We took in 80 cents for just the call. We'll get another 84 cents by selling the March 62, but it's going to cost us $1.62 to close our in-the-money call right now, the 60 strike for this expiration. But the percent if assigned moves up because we're moving from potentially being assigned at 60 to 62. Now, what I'm doing here, Paul, is this is just showing me the calls to avoid assignment. It's not showing me rebracketing the collar. But why I'm looking at this is because my biggest concern first has to be, what is my return right now? In this case, where I'm in the money, what is my return right now? And what will I gain by rolling out 7 days or 14 days or further? And is your trading plan and your approach based on rolling for a credit? Meaning that you know you have to pay $1.62 back. You collected 80 cents up front just for the call itself. Really, you got 60 cents because of the put. So if we got 60 cents initially, and it's going to cost us $1.62 to buy this back, we're at a debit of $1.02. So if you feel that you need to roll for a credit, to answer your question, how far out should you roll? You're looking at the opportunities that are offering at least a 102 credit or 102 option bid. So we've got the 23rd March 62, which is 14 days out. The 62.5 might get a better percent if assigned, but you're not getting a lot of premium. The 62 20 days out to March 29th at $1.59. And then, of course, the 62.50 at 133. But really, you're probably staying under 30 days out in this case. So you're trading a weekly collar. We started this off, as a weekly collar. So we're probably keeping it under 20 days, under 30 days if possible. Now, we know my debit's going to be 102, and I'm going to get 159 here, but I'm also going to have to give some up for the new put. That's not shown here. This is showing you roll opportunities to avoid potential assignment. And there's a long list here, but again, as I mentioned, I'm focusing on this date out in time. I might go to 28 days out with the April 62 at 187, but I'm probably not going 35 or 42 days out in time. But that also depends on your trading plan and where you are now. Okay, we've got 1.1% return after 30 days. To tell you the truth, and I know you do this too, Paul, I'm most likely just letting this get assigned because that was my target goal for this portion, this strategy in my portfolio. 5-day trade, 1.1% return, even though I use the capital. Rather than roll it, I might just take assignment. But I'm using the position analysis tool to think that maybe this March 29th 62 call, just out of the money now at 159, covers the debit I have to pay to close the call and gives me a little bit extra to buy the put. Does it work out mathematically? Well, I can see that without the put, the return would go up to 4.4% for 20 days. That falls into that line of getting about a 1% return, 1.1% return every 5 days, doesn't it? Close to it. But now I got to take a look. Okay, I can simulate this trade here and see the side-by-side picture. But as I mentioned, this is just sort of including the call. It's taking into account the put that's expiring today, but if this put was further out, it would show a different graph here. But this is a side-by-side comparison with that simulate trade when you see rollout opportunity. What I'm going to do here, Paul, now that I've decided my target is going to be around this March 29th 62 call, I'm going to go right to the what if calculations feature. This just takes me to the profit and loss chart. I see my initial position here, okay? And what we're going to do now is simulate closing these legs out. So I have the March 9th already added, the 60 call, and the 58 put. I'm going to add those back in. You didn't see it, but I just clicked on those where it said added, and it put them back into the field for me. So I have to buy this call back at midpoint. And I'm going to sell to close this at midpoint. Maybe I would just leave the long put open instead of rolling it. That way it's going to expire, but I don't pay the extra commission. But in any case, I close those out now. We took in 60 cents originally. It's going to cost me $156, $158 to buy to close the short call at midpoint. But seeing the stock's at 61.61, I'm going to assume this is at the 162 mark. Okay, so we're going to pay 162. Might get 2 cents back if we sold to close the put. So we're going to pay $1.60 back. We took in 60 cents, pay 60, so we're going to increase our cost by $1, right? All right. Now, I can add in the new 4 legs, but what I'm actually going to do here is just clear these out. We saw a $1.02 gain. So what is that going to do to our cost basis? We now have a cost basis of $60.97 to stay in the position. Based on what I saw in the position analysis, I want to see now what would happen on March 29th. We're going to sell that 62 call. But now how do I analyze what put I want to sell? Well, I started off with a 2-point strike difference that gave me the risk reward I wanted to. So to start off, I know I'm interested in the 62 call. I'm going to keep the 60 put. It looks pretty inflated, 106, but I'm getting 159. Of course, the dollar debit has already been taken into account as I adjusted the stock cost. Sell that, buy that. Okay, we're going to enter a new collar here. Okay, so in this case, based on our cost basis, based on the new premium of 60 cents, we have a really low risk of only 0.7% and a new return of 2.6%, just slightly out of the money. If the stock goes up another 39 or 40 cents, we'd get assigned in that scenario, and that's what we would look at. But I was rolling for a credit, and then I used some of that credit, of course, to buy the new put. I factored in the dollar loss into my cost basis, and now I see that this is probably a position I'd be interested in. I don't think I want to buy the 61 because that would lower this down. That would lower my return maybe back to the 1.8. Well, that's only 0.7 gain for what I have now if I take the maximum profit. So staying just out of the money, as I did with my initial structure, and keeping 2 points apart gives me a collar I'm extremely comfortable with. Max risk of 0.7%, potential return of 2.6%. I do have to remember, though, that this is for the 29th, which is 20 days away. I've already been in the position for 7 days. So for 27 days, almost a month, now you have to ask, does that 2.6% max return match your goals? If you're trying to get 1.1% every 7 to 10 days, this does not work, right? That would put you at 2.2% for 20 days max, but at 27 days, you're going to be closer to 3%. Follow your trading plan. Does the roll match your trading plan and why you're trading the collars to begin with? Okay. Now, what about the structure? Very quickly, we'll just review the other two real quick. What about the structure? Okay, I've got to answer a question here for Rajiv real quick. He commented something here. Let me go back to the what if calculations. What Rajiv said here, in the same AMAT collar, can you convert to a ratio call spread instead of selling the call? Well, yeah, you could if you thought there was further upside, but you'd have to analyze now, going out in time, what ratio gives you the spread. And remember, if you do the ratio, you're going to receive a small net credit, 10 cents, 15 cents, or 20 cents, to try to get advantage of the ratio benefit, right? I might buy the 61 and sell two 62s, but I'm only going to get 25 cents or so of net credit. I've already increased my debit by $1. So what I was saying with the collar is rolling for a credit. Unless you go 4 or 5 months out in time, you won't be able to roll the ratio spread buy back the call and roll to this ratio call spread without rolling for a credit. You'd be rolling for a debit. Okay, so again, could you? Yes. Would that match your needs? I don't know. Remember, we close these out now. We take our cost basis up to 60.97. I just did that wrong. 60.97. So Rajiv, if I tried to enter quote-unquote income method number 5 of the ratio call spread, for the 29th, I could buy 161 call at about 2.15 and sell 2 here at about $1.50, $1.60. Buy 1 and we'll sell 2. Okay. This might give me a better upside return, but I haven't factored in a put yet. Now I got to buy the put. So we've got 323, well, it's a little bit more than I thought here, but buying the 61 and selling 262s, we got about $1.10 credit. So for the 29th of March now, go back in, and I don't want the 61, might use the 60, but you see right there, that's taking out most of the premium. That's not going to be good. I have to go lower for protection. I'm probably going down to 56. So I don't take too much away from that credit I received, the $1.10. Risk now is 6.9 with potential 4.7. Okay, you see that? So I've locked it in here. I've got the advantage of potentially the ratio call spread, but I didn't get as much credit as I wanted to. And I had to give up more of that here, but I went so far down with the put strike, this doesn't give me the ratio I want. Okay, so yeah, for weeklies, for shorter term, it might not be the best idea, but let's roll it up. What if we did use that 60 and used up almost all of that new credit we received? Buy the 60 put again. Oh, I'm on the wrong day. I'm sorry. Got to go to March 29th. I'm sorry, folks. The 60 put right at about 106. We buy that as we did in the last one. I'm sorry. I only got buy 1. My apologies. All right. Now it's looking better. Okay, it's still a potential 3.4% return with the ratio call. It does look a little bit better, but I got to make sure that I get enough credit up front, and sometimes that's difficult, as you mentioned, with the weeklies. 2 weeks out, I'm going 20 days out here. I couldn't go to the 16th and do that. Net credit would only be 10 or 15 cents, and I wouldn't have enough to buy the put. This one does not look bad. It's an increased return if the stock is above 62, but I have a 1.5% risk now, double what I had with just rolling to the standard collar. And we went from 2.6 return on the standard collar to 3.4. So a little bit better return if we're right, doubled the risk if we're wrong. So that's a balance, okay? All right, now back to VXX real quick. Same process. Let's look at position analysis again. This is the one that's gone against us for the max loss. On Monday, we could have bought VXX at 43.32, sold the March 9th 44 call for $1.65, bought the 41 put for 30 cents. Rich premium, $1.35. Potential return was pretty good. Max loss was pretty low, but we're at 38.28. We're at the max loss for the position. Now, it's technically at expiration. If we leave it alone, what happens? Well, our call expires worthless. Our broker would exercise our 41 put this afternoon or tomorrow morning. We'd be out of the stock at 41, so we'd have the max loss of 2.3% on the position. Now, in this one, no rollout opportunities were shown. I may be able to re-bracket this. Sell to close the put, let the call expire, or roll the call again. See, if you wanted to roll this, this is questions you've had before, Paul. If I want to roll this, if I want to re-bracket this collar, I have to roll that short call. I can't just let it expire or 3:30 this afternoon sell another call and leave this one open, because at one point I have a naked call. I don't know how your broker is going to handle that with you, if they're going to charge you more margin, what they would do in that position. So to avoid that, you'd want to roll this call. And you might still have to pay 3 to 4 cents for an option that you have no business paying 3 to 4 cents to. In this case, what you may want to do is roll down the put to re-bracket the position, leave the upside open, and then Monday see what happens. But now you take the risk of the stock falling and not getting any good call premium. So again, I opened again. This was a 3-point spread in this case, 44 to 41, and it was out 5 days. To roll this one, we know that I want to let the call expire, but I'm going to have to buy it back if I want to roll it. So buy it back for about 1 cent or 2 cents. We're going to sell the 41 put for about $3 or so. $2.75, $2.76, something along those lines. Okay? So we buy to close the call, sell to close the put. It's got to be, oh wait, it's the 40. Yeah, it's the 41. So that's got to be at least, well, it's VXX. It doesn't have to be intrinsic. At midpoint, they'd give me 212, which is not going to work. I should be closer to 230, 240 because intrinsic value alone, but that's not how the VIX is calculated. The VXX and the VIX are calculated. But anyway, let's say we did get 240 for it. Why am I showing just closing the 2 legs? We're selling to close the put we bought, buying to close the call we bought. What does this give me? It gives me a stock position with a new cost basis of $39.58. We kept the premium from the call originally. We got $2.40 gain on the stock. We lost almost 5 points, over 5 points on the underlying itself. So what do I know now? Now going ahead to next week or 2 weeks out, got a cost basis of $39.58. And what would I probably do? To create a collar, originally I bought the stock at $43.32. I sold the just out of the money call. That was part of my trading plan. That's part of my structure that I would have established. So now rolling 14 to 20 days out, I don't think I would roll 7 and make this worth it, but going 14 days out, I'm probably going to stick with that same sort of at the money call, and I'll try to keep the same structure I had initially, 3 strikes apart. 39 call, 36 put. New cost basis of $39.58. This is not going to look attractive, Paul. You can already see that, right? Because I'm selling the 39 call, which is slightly in the money. I probably need the 40, but I'm not going to get enough premium. But still, here we go. I still have a max risk of 5.9%. But if it recovers and it moves back up above 39, we can make a 2% return. Okay? So that's not too bad. Originally, we were looking to make a little bit more than that. Okay, it was almost a 4.5% max return, 4.8%. This was extreme because it was highly inflated. But now we can turn a loser into a winner if it does recover. But right now we'd only get out with a 2.3% loss. Is it worth it to risk up to 5.9? Honestly, in this case, the answer is no, because this is VXX. All right, if we're assuming the market's going to settle down, what's going to happen? VIX is going to continue to drop. I don't want to be in a collar here. But mathematically, if this was a standard stock, that's what I would do. What is my cost to close the 2 existing legs? How does that adjust just the underlying that I have now that the stock is below both strikes? And is it worth it to re-bracket the collar, or is the increased risk going forward, 14 days or 20 days, not worth it for me? If I can close right now for 2%, do I want to take 2.4%? Do I want to take almost a 6% risk? It starts to move against me. All right. The main question, though, let's look at SNE. Last one real quick, and then we've got a couple questions from Rajiv. We've got email questions from John B. The other day, yesterday, I cheated on this one. I just looked yesterday instead of Monday. But yesterday I could have bought Sony at 50.30, sold today's 51.50 call for 30 cents. Not great, but the 49.50 put would have only been 5 cents. Here we are looking to have my call and my put expire worthless. Would I let that happen? No. Why? If I just hold it through expiration, let the call and put expire worthless, well, I've lowered my cost basis down to about 50.25, and the stock's at 51.40. I'm looking pretty good. But what happens over the weekend? As if Monday Sony drops down 2 points and is trading at 49.40. Well, yeah, I've lowered my cost basis to 50.25, but now I'm at a loss and I can't get the premium I want. So I look down at the rollout opportunities. Now this is assuming that you've got a gain in the stock now, and I see rollout opportunities that don't match what you want to do, Paul. This is creating a married put far out in time, rolling out to July, buying the 5250 put. So for the next 133 days, I only have a risk of 4.9% and infinite upside. Okay, it's not a bad idea based on your outlook for the stock going forward. Okay, we let these expire, we buy the long put. Okay, and now we have a married put position, essentially, with unlimited upside. But you're talking about the collar. Okay, and here we are now, regardless if it's today, Paul, this is an expiration for today, or even if this was for March 16th. If we're in a position where the stock is here, and you want to know, is it worth it to roll it out? Well, we would do the same thing. Okay, but in this case, if the stock's right in the middle of where we bought it, let's say my stock isn't at 51.40, it stayed right at 50.30 for the first 7 days. These are the March 16th options. Well, I can leave them open because I still have the structure that I want. Is it worth it to buy back the call for gain and sell a lower strike call? That's where you use the profit and loss chart. Is that going to give you the risk reward you want going forward with a lower potential return if assigned, even though you're generating more premium? Okay, it's not going to work out that way. What do I mean? Let's say this was the 16th of March series. And again, this is our 5150. But let's say the stock is right where we bought it, at 50.50 or 50.30. We've lost 7 days of time value. Is it worth it to buy this back for a 30-cent gain or 20-cent gain and sell next week's 50.50 call for another 40 cents? Well, no, because I don't think so, because you've gained 70 in that situation, but you're giving up $1 in potential assigned return. So you get a little bit, you're going to lower the risk, but then you'd also lower the return. And is that going to match your goals? This is the original position that matched your goals. By lowering the strike, if you have a gain, if the stock's trading between the strikes, and you still have 7 to 10 days to expiration, lowering the strike, yes, you'll make a profit on that initial call, and you'll get a new premium. But very rarely, unless you caught this at a high implied volatility and sold into a high IV, and now it's low IV, very rarely will the additional gain from premium be greater than the loss you're taking on the strike. So that gain you got from the short call and then selling the new premium will usually be less than the $1 you're giving up at potential assignment in most cases. Okay, so that's just the way the weekly options work when we're going shorter term on these positions. Okay, let's take a look. Let's do that quick example. I'm going to go to the chain for, let me close out of these two here. Leave this one open. Close out of that one. There we go. I'm going to go just to the chain for SNE. Okay. Now this isn't, oh, I'm sorry. Let me just go to the chain for SNE. The stock's at 51.40 right now. It's up only 12 cents. Okay. So let's say that yesterday, let me go back a day very quickly. I'll go to the 7th. And the stock was at 50.89. And instead of the 9th, let's say we went to the 16th. Okay, now this one isn't really going to work, but let's say we went to the 16th. We got 60 cents for the 51.50. And for the 48 put, I'm sorry, 51.50, we got 60 cents. And for the 49.50, we paid 40. All right, we probably wouldn't have entered that trade, but let's say that we did that. Let me go 48.50. Okay, I'm sorry. Let me go 48.50 there. We'll go 25 cents, 20 cents on it. Okay, now stock, remember, was at 50.89. Let's plug this in. So if we open the position the other day, using the prices from the 7th, but we sold the 16th March series, we got 60 cents for the 51.50. Not a lot of decay, but that's important. Oh, that's important, right? And then we would have done the $48.50 because I wanted a cheaper price, and I'm going to pay 25 cents for it. Now, our 51.50 call that was slightly out of the money now, Paul, that's really become at the money. So we saw already that buying back that call, we haven't seen a lot of decay yet. It's priced right around 65 cents. It's actually moved up. If we tried to get midpoint, 63 cents or so. So in this case, I'm just leaving it alone. Okay, oops, sorry about that. In this case, I'm just leaving it alone, and I'm not likely to roll it. Now, if it had dropped a little bit, if it was still trading at 50.30, didn't move, and I had some call premium here, a gain, but it probably only would have been 15 cents, it wouldn't be worth it to roll down to the 50.50 at this point, because I'm giving up $1 for the potential assignment. The premium is going to be less than the $1 I'm giving up for potential assignment. I would lower the risk, but then my return might only be half of what I originally expected or less in this scenario. If you had sold this call for $1 and could buy it back for 50 cents and then sell the 50.50 one strike lower for another $1, that would work. But it rarely happens that way because both options are losing time. Right? The one you're rolling down to and the one you initially sold, they're both losing time value, and you're giving up the $1 in between. Okay, so my steps in your scenarios is that I still will use that position analysis view. I'm going to base my structure, which calls I'm selecting, based on the original structure I entered. Okay, whether it was 2 points apart or 3 points apart, whether I sold a full strike out of the money to begin with, or whether I sold right at the money to begin with. That's the option I'm looking at now. So on AMAP, for example, I sold right at the money. Now the stock's at 61.61. My focus, you saw, was going to be on the 62 strike, the at the money strike for the position, because that's how I was developing my initial trades. That's what I would look for if I opened the search. If I let AMAP be assigned, then went into the search to identify a new position, it would be the at the money 62 if AMAP came up. So I'm going to use that as the same trading plan of what I'm looking to roll to. I'm not going to say, well, AMAT's been on a long run. I think it has higher to go. Let me buy back the 60 for $1.58 or $1.61 and sell the 65 call 2 weeks out for 40 cents, hoping it's going to go to 65. No, I'm keeping the same trading plan I've structured in my portfolio and going out of the money, or just at the money. Okay, so that's how I use the position analysis for rolling my collars. My standard collars, the dynamic collars also have different views as well if I'm doing things such as radioactive trades or married puts, which we already saw in that scenario. All right, let's go back to the slideshow real quick. Change screens here. And just wrap up that, I did write something here. It's not in depth very much at all, but it's just sort of a review of what I just said. When analyzing a collar, you have to ask yourself what we kind of reviewed. Is it better to be assigned and take the max gain? If you're going to get assigned and take the max gain, is it worth rebracketing the collar, or should you stay where you are and let it be assigned? Okay? You should only rebracket in that case if increasing it 7 days out, 14 days out, or 20 days out still matches your return on position. Is it better to close out and take the maximum loss, what we saw in VXX? In this case, I probably would. I developed my trading plan that when I open these collars, I'm looking for 2-3% gain, but if the stock falls and I take the max loss of 3, 4, 5%, I'm okay with that. So I'm okay occasionally taking the max loss. Is it worth it to rebracket it? I don't think so. All right, VXX is a specific case, but if I opened a collar on a standard stock, buying it at 43.30, selling the 44 call, and bought the 38 put, I'm sorry, the 41 put, and now the stock's at 38.28, what does that tell me? I was wrong on the position. I was wrong on the bullish nature of the stock. So I don't think it's worth it to try to save that position by rebracketing the collar down now with a stock at 38.28 to say the 39 call and the 36 put, or even the 39 and the 37 put, because the risk went up to 5.6%. I'm only taking a 2.3% loss now if I roll down, and it continues down against me, now I'm looking at a 6% loss, double what I have right now. That I don't like that. I'm going to let it go for the max loss, open a new collar using the search tool that I'm more comfortable with. When the stock's between the strike prices, whether you still have time to expiration or you're right at expiration, first thing to analyze we did with Sony is look at the profit, the position analysis. If you close the position now, is it at a profit? It's not max profit. It's not the profit I was expecting because the stock's still below my short call, but maybe I take that profit and try not to rebracket the position. However, if you're still comfortable and it looks like you can get a better premium rolling 14 days out with that same call and put you have right now, moving it out, if you still match your goals for the additional 7 or 14 days you'd be in the trade, maybe you rebracket. Naturally, if it's between the strike prices and I'm at a loss, whether I'm at expiration today or a few days away or 7 days away, I may plan to rebracket the position in that case. But remember what we just looked at. It's not always worth it to just roll down the call unless the initial premium you received for selling the call minus the buyback cost plus the new premium on just the call is greater than the strike price difference you're giving up by rolling down. If I'm only getting a $1.80 positive premium by rolling down, but I'm giving up $2.50 in strikes, that's not worth it. It will lower the risk, but I'm also lowering my return, the potential max return I originally looked at. Does that still match my trading plan at that point? Probably not. I'm probably going against my trading plan by doing it. What do I mean by trading plan? I wanted to receive at least $1, or I should say maybe 1% per week, or 2.3% every 30 days. If I start rolling down the call because the stock's moved, now my 30-day return might only be 1.6%. And that's not matching my trading goals, okay? And when I decide to roll, I typically just keep the same strike difference I started out with and the same strike range, meaning that if 90% of the positions I open, the short call I'm selling is within 1% of the underlying stock price, I'm not rolling to a call that's 3 or 4% above the current stock price. That's not my trading plan. That's not my trading method and what I've been looking for. I've been looking for at the money, just maybe a little bit out of the money to still have a 50, 55, maybe 45% probability of being assigned, a little bit of upside maybe. So why would I change that by rolling? Now that the stock has moved up, I've got to buy back my in-the-money call if I want to stay in, but I'm going to the next at-the-money strike to maximize the time premium. All right? Okay. Let's move on now to John B. real quick. 2 questions he had, 2 parts there regarding different things. John asks, what's the best daytime during the week to buy weekly call options on a stock if you're bullish? I'm going to be direct with you, John. I don't know. I don't buy weekly calls. I think it's too risky. I know that there can be profits. If I bought calls on the 3 stocks we look at today, AMAT and even Sony at the beginning of the week, they both would have been profitable. Had I bought at or slightly in the money? That's the next question you have there. But again, other weeks, I'd be at a loss. I'd watch that time to, if there's a 2% drop between Monday or Tuesday, let's say I picked up the option on Monday, there's a 2% drop in the stock, that weekly option, if it was at or out of the money, probably just lost 60% of its value. Now, it might come back if the stock regains in the next 2 to 3 days, but that's tough. You want to be selling shorter term, selling week by week, and generally you want to be buying further out because it's higher cost up front, but it's a lower cost per day. So I don't have an answer for you, but I'm going to say Monday. Why am I just blatantly saying that? Well, you come to this question later on regarding your follow-up question, which is on the next slide. But I don't want to buy a call on Friday that expires next Friday. I didn't want to buy a call today that expires next week. Why? Because I don't know what's going to happen over the weekend. Now, sure, the markets could gap up, and on Monday we could see an increase, and I'd be looking really good. But if it falls the other way, I'm probably at an 80% loss of the time value I paid in the position. Now, I really have to hope the next 4 days the stock recovers so I can get some profit back. Okay? Now, you go on to say, what's the best strike to buy? At the money, 1 strike in or out of the money, or out of the money options? There's no answer to that question. It depends on your expectation, and we have a tool for that, okay? So if we go to Power Options, and we go to, I don't have it added here. Oh, I have long put, but so I can go to the long option finder. It's one of the signature tools as well, what's called the long option finder. We'll just take that position we were just looking at with Sony, and we know it's at about 51.40, okay? So let's say that I think the stock's going to be trading at 52.10 in next Friday, and I'm looking to invest maybe $500 into options. Okay, so I think it's going to go up another 70, 75 cents by next Friday. Okay. Now, the stock, remember, is at 52.10. If I expect it to be trading at my projected price, is 52.10. The stock's at 51.40. I'm sorry, stock's at 51.40. My projection's 52.10. Let's take a look. The 49 strike, the in-the-money strike in this case, gives me the best return of 15% for next week, which actually goes out to the 23rd there. Let me go to the 315. I'm sorry, let's try 315. Instead of expiration day, let's go one day before. There we go. All right, so the 50 call, the slightly in the money call, gives us the best percentage return. All right, and they're about even because they're 50-cent strike differences. Is the out of the money call better? No. Right, so if I bought, it's not even shown here, the 51.50. If I bought the 51.50, so you see here the 50 is at 168, the 50.50 is at 128. That means the 51.50 is probably around 68 or 70 cents. So if the stock went to 52.10, it would actually be at a loss. You didn't make enough money in order to do that. Now this is a small gain, I realize, but it depends on your expectations. This is only a 70-cent gain over a 4-day, 5-day period, okay? So the in-the-money options would be better. What if you projected the stock would go up to $54, have almost a $2.50 move in the next 5 days? Well, in that case, yeah, the at-the-money, 51.40, the out-of-the-money calls are going to give you much better bang for the buck because they're only 25 cents, 30 cents, 18 cents. But if the stock hits 54, this will be worth $1.50, right? We could pay 25 cents for those 52.5 calls. They'd be worth pretty much intrinsic value on March 15th, 16th of March expiration, so you'd have a good return, okay? So there's no one answer because it depends on what happens to the stock. I hate to say that, but that's when you're trying to play weekly options, you're playing because you're bullish. You think the stock is going to grow and move up in time in the next 5 days. To where? And this tool will determine, based on your target price, your expected date, of course, which would only be, the day before expiration next week is the way to do it. But if the stock hits your target price, this shows you which option would give you the best return. Okay? And if you expect a small move, again, 52.50, 52.10, you're going to be looking at in-the-money options. At to slightly in-the-money options are going to give you the best return. If you're expecting a bigger move, it's going to be out of the money. That's the only way to answer that question. So which strike to buy? Those. When do I buy? Usually on Monday if I'm comfortable with the market. Okay, so today we saw a big move up on most stocks, right? And the indexes were up significantly. I don't know how the market's going to open on Monday. If it opens down, then maybe that would be an opportunity if I think stocks are going to recover later in the week. If it opens up and I think the market's going to be strong, maybe I want to catch the wave, but I don't know what's going to happen. You're taking a 50-50 shot, honestly, buying it over the weekend, buying it on Friday for next Monday. Because what is this doing? Buying a weekly option that's cheap doesn't give you good enough and effective enough time to manage it. What do I mean by that? If I buy a call right now, shorter term for profit, I'm probably buying at least 4, 5, or 6 weeks out in time on a stock that offers weekly options. Why? Because now I have the opportunity, if things don't go my way next week, I can convert it to a calendar spread for the 16th of expiration on the short option and still have my April 6th or my April 13th option available, a long-term one. So I'm going to try to cut the cost basis using the near weeklies, holding an option that's 4 to 5 weeks out in time, okay? That's what I'm going to look to do. I don't want to necessarily buy I don't think it's a great idea to buy options that are 4 or 5 days at a time unless you're really confident with a stock, you really feel that you know what you're doing. Or you're doing a straddle for an earnings play. Okay? Now, let's move on to your follow-up question. This is not to say, I don't mean to come across this way, John. This isn't to say that this is the wrong question to ask. I just don't do weekly options. I think it's better to buy them further out in time. Even though more expensive, you have lower cost per day on those positions. I'd prefer to enter new positions on Monday, not necessarily leave them up over the weekend with this kind of speculation. Okay? And now, further in depth, you ask, is there a triple play strategy that keeps your upside open but limits your downside? Yeah, there's a synthetic and there's a ratio back spread. Okay? And then you say, how would you decide which option and strike prices to choose to establish the above position? Well, that again has to come down to what is your risk-reward tolerance. Let's take a look. All right? So we're talking about synthetics. We're talking about three-leg options positions that have low risk but leave your upside open. What's the main strategy that has low risk and leaves the upside open? Well, a long call where you're taking 100% risk of your position, and a married put, which buying the stock and buying the put still gives you a controlled risk on the position of 4 or 5%, but it requires the capital to invest in the position. Can you do the long call for a cheaper price or the married put on leverage? You can, but it comes with a lot of buts. All right. So AMAT or Sony, doesn't matter which one. Let me see here. I'll just use AMAT real quick. We were looking at that one earlier. Now, I know that I can go out in time, 7 days, 14 days, what have you. Let's just take 14 days. I'm bullish. I think it's going to be a strong stock. I can buy a 62 call for $1.30. Okay. What does that give me? Well, it gives me a long call position with a maximum risk of $1.30, $1.33 in this case at midpoint, with unlimited upside profit potential for 14 days. It's kind of obvious what that is, okay? I could also do a married put. Why would I do that? Well, it depends again. I wouldn't do it this way, but I could buy 100 shares of AMAT and again go 14 days out to March 23rd and buy the 62 put as a fair comparison, buy one contract. Instead of investing $133, I'm investing $63.29, only risking $1.30 or 2%. Okay, so I would never do this I would never do a weekly married put. Okay, John Crowder, or oh, geez, no, not John Crowder. John C says, I don't know why. I'm sorry, guys. The system's doing this differently. And it wasn't even the name I mentioned. It's a different John C. In any case, says, why not do a covered call? Well, the idea was to keep the upside open. And a covered call gives me a little bit of premium for a shorter term frame. And maybe I agree with you, John, in this case that for 7 days out, this might be a better trade if I'm neutral to bullish. But this is the question. The question was to have a low cost with a three-legged options trade and leave the upside open. So the covered call gives you a 2.9% return right at the money, but it comes with a full risk if the stock collapses. Not the target here, but I would prefer to do a weekly covered call than buying a weekly call personally myself, John. That I agree with. In any case, we saw the risk of the married put was $1.30 or 2%. Risk of the long call is 133 or 100%. That's the lie of leverage. Can I do better? Well, you can mimic that structure by using the synthetic. What's a synthetic long stock or would give me a synthetic long call? Well, it's the same in the sense that I can buy the 62 call. I can buy the 62 put. Strike that. I can buy the 62 call. I can sell the 62 put. So that's a synthetic long stock. And now I can buy a cheap, maybe 58 put. All right, what does that look like? Well, that's your synthetic. You buy a call, sell the put, same strike, same expiration, and you buy another put. Or you could look at this as a bull put credit spread 4 strikes apart for a net credit of 70 cents with an extra long call. Now, this mimics that, and you'd say, oh, well, I'm still getting a net credit of $2 instead of paying out. Remember, because your long call cost you $1.33. Here you're actually getting a net credit of 2 cents. But you have to cover this difference in strike prices, which is $400. Because if the stock falls below 58 now, you have an obligation to buy shares of stock at 62. You can sell them at 58, but you've got to cover that $400 difference. The long call does not cover the margin requirement of your bull put credit spread. But that is a synthetic long call. It's a synthetic married put. Personally, it's just not as effective. And you say, oh, well, let's move the strikes closer and use the 60 put so we don't have that big of a risk. Well, now you're not going to have a credit. You're going to have a debit plus the $2 difference, and the risk is higher than just buying the 62 call. Okay? That's the comparison of a synthetic long stock. These two alone is a synthetic long stock, and you can convert it to a married put by just buying a cheaper put, but it's actually better just to do the married put outright in this scenario with these prices, these particular, even though you're getting a credit here for this synthetic of about 30 cents. And at the same time, buying the extra put as well. John says, what is the required funds for the broker to fill? Okay, let me take this out again. So that was a synthetic, John, I just showed. You had bought the call and sold the put, and you saw a profit and loss chart that looked exactly like owning a stock, but you were doing it at a credit. You still have all the risks to the downside. Really, it's a naked put with a long call. You can define it that way. The synthetic I showed initially is if I bought the 58 put, sold the 62, and bought the 62 call. Let's leave the 62 call out of the equation. What do I have when I sell a 62 put and buy a 58? I have a bull put credit spread, 4-point strike difference. I sold a put which obligates me to potentially buy shares of stock at 62 if the stock is trading below that price at expiration. I have bought a put at 58, which gives me the right to sell to close the stock, sell that stock to somebody. Okay, so if the stock gapped down to 50 for whatever strange reason, and AMAT was at 50 a couple months ago, but if it fell suddenly to 50, I may be forced to buy stock at 52, but I've reserved the right to sell it, force someone to buy it at 58, so I can only lose the 4 points. But my brokerage is going to require me to cover that risk, that difference in the margin requirement. The most I can lose is the 4 points. For one contract, I'd have to put up $400, have it on hold in my trading account to cover the obligation of the credit spread. To complete the synthetic we were talking about, again, we add back in that long call at 62 to keep it even, but the long call does not cover the obligation of the short put. Short put is assigned to you if the stock's below 62. The long call expires worthless, doesn't give you any help. So when you combine them together, yes, you get a long call, similar risk-reward profile to a long call, but the risk is high because the difference in strike prices of that bull put spread. The 4 points between the bull put that you have to cover. Now, going back to John's second part of the question, okay? So, he said, which strikes do you choose? Well, when you're trying to do a synthetic, you're really selling at the money. You could evaluate it with the 6150s, but the call and the put, the call you're buying and the put you're selling are going to be at the same strike price 90% of the time. You're going to be right at the money. And then you're looking for a put that you can buy that doesn't throw the position too far out of whack. And again, why am I not giving you one answer? It's because there is no one answer. It depends on the prices that are being offered by the exchanges, how much risk tolerance is in your account and what you're willing to risk. And at the same time, does buying a put too high of a strike affect your potential return if the stock only moves up 2%, 1%, or more? Okay? All right. Now, another approach commonly used by investors are called ratio spreads. A ratio call spread that Rajiv had brought up earlier and I would only do a ratio call spread if I own the underlying. But if I bought one slightly in the money call, at or slightly in the money call, and sold two out of the money calls, or twice as many. Or you can also sell 3 and buy 2. You can sell 7 and buy 5. That's a standard ratio spread. There's an infinite number of combinations you can use. But let's just talk about a ratio call 2 to 1. Okay, let me go ahead and submit that. This is a spread where I'm going to generate a credit of $82 up front because the at the money, slightly out of the money calls, double the premium, gives me a credit. But this is not what you're asking for at all. This is the exact opposite of what you're asking for, John B., in your original question, because this has infinite risk to the upside. But if the stock stays the same or moves down, you have a good profit. The problem here is your margin requirement is over $6,000. You might as well just be buying the stock. Why is your margin requirement that high? It's very simple. You sold 2 calls and bought 1. So you have a bull call debit spread with a naked call, which you're only going to be able to do at level 4 trading. So why am I showing you what not to do? It's because this is what's called the ratio spread. A ratio back spread is reversed. I'm going to buy 2 and sell 1. Or maybe I could sell the in the money and buy 2 higher strikes. But let's look at this one first. I'm going to buy 2 61 calls and sell a 62. Now I'm going to pay a higher premium. This is going to be a debit of 233. But that's the most I can lose, and I have unlimited upside. Where's the problem? The problem is just buying the 14-day out call. If I did it right, I think I did the 14-day out call, or the 7-day out call. This is the 14, I'm sorry. But buying the 7-day out call we looked at was only $1.33. Doing the married put and putting up the $6,000 is only a risk of $130. You're almost double the risk with this ratio back spread setup. Okay? Does it work the other way if I buy 2 of the higher at the lower price and sell 1 of the lower? I know this gets confusing, but this is where we go. Now the risk is still 183. You have a low risk here, and you have infinite upside profit also. Okay? You can do it both ways. Why is this not something that's a good idea? Look, the maximum risk here is a little bit lower. It's about at $85, $95. The real max risk at 183 occurs here if the stock doesn't move or stays right around 62. Okay? Then you do have infinite upside, but not till the stock goes to 63.83. Is this your target for the stock for the next 7 to 14 days? Do you think it's going to move up another 2 points just to break even or go higher? Because if your target range is somewhere in here, you think the likelihood of the stock ending in the next 7 to 14 days is between 60 and 63.50, this play doesn't work, even though it's lower cost. It still carries a relatively low risk if you're disciplined. If you overtrade it, you're taking on a higher risk than just buying the call itself or the married put. Okay, in these numbers. Not every stock's going to be this way. Okay, not every stock's going to have these same prices, but that's the issue. There's no one answer to what strike should you do for the synthetic, buying a call, selling a put at the same strike, same expiration, and buying a put to protect it, or by doing one of the ratio back spreads. That's going to be dictated by what the premium is being offered by the exchanges, what's available as far as expiration. John goes on to say, what if you do a time spread and sell the in and buy the out? Well, yeah, I could do a diagonal spread, but that's a different strategy. That doesn't leave the upside open, right? My upside would be capped, same as before. Same as with the covered call, John, okay? We were looking for ones that offered an infinite upside. Now, could I do this in a combination where I'm buying 2 that are out to April and selling 1 to March? Well, sure, but remember, this cost is going to be 3 times higher now because I'm buying further out in time. Let's buy 2 April 13th, 62 calls at 215, okay? So instead of buying the same expiration, we buy those and pay about $400, $440. We get the 183 back. Oh, Oh yeah, now it's sort of a strange little spread because it's a time spread, right? This is showing us at near-term expiration, where there's still a potential loss. The max risk is now 259 in the short term, and the profit is still infinite as the others. But again, this is another part to sort of answer what John was asking. Why can I not give you a direct answer to what strikes are being used, what strikes you should use, and so forth? And that's because there's multiple ways to skin a cat. A synthetic is a three-leg way that could mimic buying the call, but you might not get a better price. You might actually have a higher risk based on what's being offered to do that bull put spread with the extra long call. The ratio back spreads, depending again on what premium's available, you're looking at a higher risk than just buying the call outright for 7 or for 14 days out. A higher monetary risk than just doing the married put, but you're using leverage. And all that being said, remember, doing leverage can get you into worse trouble. If I just bought the call at 133, you say, hey, that's the same risk as the married put. But Mike was going to put maybe $6,000 into it. As I mentioned, I would never do it short term like this. If I buy a put to protect a stock, it's 6 months out in time following the radioactive trading techniques. All right. But you could say, oh, well, that's Mike is putting $6,000 in and has a risk of $1.30. Well, I'm buying calls and I only have a risk of $1.33. I'm only putting up $133. I could buy 10 contracts and have just over $1,000 invested. Now you have $1,000 at risk. The stock falls 5 or 6%. Your calls are going to be down 40 to 50%, especially with 7-day trades. You run the risk of over trading trying to use a synthetic or ratio back spread. So you've got to be disciplined. Okay? You can't trade more than you're willing to risk. And the monetary risk on any leverage position, any synthetic structure, the monetary risk that you could lose on the position should not represent more than 2 to 3% or so of your total portfolio value, just like any other strategy, any other single position. Okay? Bull puts come with a known risk. I trade bull puts in my personal account, but I make sure that the maximum risk I take if all goes against me is not going to be more than 2.5 to 3% of my total portfolio. So I'm only doing a few contracts because eventually I will take a full loss. That's going to happen. The unexpected will happen in the synthetic, in the ratio back spread. You'd still consider them low risk because you have a low monetary risk. We looked at risks of $130, $180, $245. We can say that's low risk for one contract. You do 2 contracts, that goes up to $480. 3, you're at $720, and so forth. Live leverage works both ways, and that's always important to remember. Okay? All right. Now, and John mentioned that, I'm sorry, your broker will not do credit unless you have an equity position of $25,000 or more. Yeah, some brokers do have a limitation, others don't, based on how often that you've traded as well. And what I mean by how often is sometimes I was approved for trading the credit spreads with under $25,000 because I had done 100 trades over a 3-year period. Okay, and that's what ended up happening. Okay. John, I don't understand your question. He says, where do you find stock info that gives you the results you were teaching? I mean, I don't have a search for ratio spreads, okay, and I don't have a search for the synthetics. I typically would go just for a long call. I'm using this because this was one of the 3 examples we were using in a collar, and this is actually a married put I'm in, as well as Sony. So I know those stocks. That's why I use them for these examples, because I know how they've performed. And actually, going along with what Rajiv said, I was going to do an income method number 5, a ratio call spread on my AMAT married put today, but I decided it was better just to sell the call for some of the similar reasons I just mentioned, to not get it too confused, to get a better premium in case there's a pullback over the weekend. Then I can reevaluate the position next week. Speaking of Rajiv, he's been patient. 4:30, sent in his question. 4:38, an hour ago, he sent in his first questions. He's been commenting along the way. He says, hi, Mike, I have one query on the PowerOp tool. What are we looking at right now? Okay, we're looking at this here. Okay, that's fine. Yep, okay. Sorry about that. Let's go back over to the other screen for a moment. We'll go back to PowerOptions here. Right, so Rajiv, sorry. if you open the bull call debit tab, which I don't have, so let me add bull call debit to one of our available strategies. I'm going to take out iron condors. Okay. Bull call debit, and okay. There we go. So I'm sorry, Rajiv, this is, all right, question here. Sorry. And looking for positions, found that whatever was suggested tool may never fulfill because it says it's deep in the money. Example. Okay. All right. I got you. Okay. So you're saying I went to bull call debit. I went to search. We're looking for in the money debit spreads that have a higher probability of being assigned. First one that comes up here is light. This is on the weekly. It's a 65.50 with a bid of 380 and the 64 with an ask of 550. The debit's showing me 95 cents. Well, that's $1.70, isn't it? How am I getting 95 cents? Because it's looking at the midpoint, okay? Not the natural, it's looking at the midpoint. And Rajiv's question is, this isn't his specific example, but he's saying that it's, I'm sorry, he's saying that he couldn't get filled at these prices. See, the bid is 380 and the ask is 550, which would be a debit of 170, which wouldn't make this profitable because it's only a 150 spread. But at midpoint, we could get 95 cents. Now, he's not saying this position. He had a different position, but it was on First Solar. But the general idea here is he's saying that, look, for this weekly bull put out to the 16th, bull call, excuse me, because we're going in the money, we have a 70-cent bid-ask spread here and an 80-cent bid-ask spread here. If we did it at the natural, it would be a losing position, but we might not get midpoint because it's so deep in the money. In his example, for First Solar, FSLR for April 20th, okay, so let's look at FSLR. For April 20th, the 57.50 call deep in the money is 10.95 to 11.40. That's only 50 cents. I would assume that I could get a midpoint at 11.10 for this. And then the 55 call, 11.55. Now that one's wider. 11.55 to 15.05. I don't know if I would get 13.20, 13.30 for that. That'd be a tough one. A little bit higher than that, 13.60, 13.70 to buy that. He's going to push me towards 14.12, 14. I'm sorry, 14.20, 14.30 if possible. But your question is, that comes up. That's the risk of using midpoint. And for the past 2 years, we've had people, most customers were just begging for the midpoint on the spreads and the iron condors and so forth. So we showed the midpoint calculation there as well. And so now you're saying, is there a better way that I can define this? Can I avoid this? Yes. Okay. In any search, when you're looking at spreads, iron condors, bull put credits, bear call credits, even covered calls, and you're seeing results that you don't think you're going to be able to get filled at midpoint, you can use the monetary bid-ask spread limitation. So I only want to see spreads that are less than 50 cents. Bid-ask spread on the short option, less than 50 cents on the long, or I can do it by percentage. And this is based on the bid price. So I'll start off with maybe I don't want to see anything that has a bid-ask spread that's more than 25% of the bid or the ask. That might be too restrictive, right? But now we've got some good positions with some good returns. And then, you see the short option bid here is 425. The ask is 620. So you'd say, well, that's $1.95 debit, but it's showing me a midpoint of 155. I bet you I could get that. Based on the bid-ask spread of the two options, I bet you I could get 20 cents lower for each, 40 cents here, so the net debit's only 155. Honestly, if the net debit was 195, I would still be on a 2-point spread. Oh, no, I need it at 155. You're right. So that's more likely, okay? I'm looking for a good spread. 2.5-point spread here with a 205 debit, and it's right about there. Okay, it's $2.30 debit here, but I bet you I can get 20 cents off on $182 stock on Wynn Resorts, even though they're in the money options. Or you could restrict this further, depending on what you want. So I limited it so the bid-ask spread on the short call or the long call can't be more than 50 cents monetarily or 25% of the bid price. So I think that's going the right direction. That's what you want to do, Rajiv, there to take a look on that. Okay, all right. Okay, let's see here, John. Let's see. There we go. Okay, that's that one. A couple more comments here. So John says, do you have to analyze all the stocks? No. Okay, let me think about this for a moment. I do this sometimes, but I have to think about it in reverse. I don't have a ratio call spread screen, nor do I have that synthetic long call screen that I showed you. Okay, you know, I built a synthetic on AMAT and I built a ratio back spread on AMAT. Okay, I don't have a search that does that, but you might be able to use the bull call debit spread search, you know, where I'm selling an at and buying a deeper in to perform a ratio. Meaning, what would I be looking for? I'd be looking for this same structure, but maybe slightly out of the money, right? So to do the synthetic we were looking at, the ratio spread we were looking at with the stock at 139, I might want to sell a 140 and buy two 136s or two 138s. Or remember, I showed you the other way, buy two 136s and sell a 140. Okay, so I would look for a debit spread position that was slightly out of the money. I would customize the search that way, but look for ones that have almost a 45 or 50% return. So that shows me one where the premiums are off, but might give me a 50% return. So if I buy two, I'm not overpaying for the cost. It's a little bit more complicated, and I might have to review that with you later, John, via email there. But to do those sort of ratio ones that we were looking at, I'd have to use a debit spread search, and to look for the synthetic, the other synthetic, I'm sorry, when I talked about the synthetic long stock, I would do a bull put credit spread at the money with a high return. And then once I found the spread that I wanted, you know, I'd take this out. Let's go to bull put, and I'll just go to the weekly bull put default screen. Fantastic. But I'm going to change something. I'm going to double the net credit. I'm going to put the return up to at least 40%. And I'm going to go no more than 2% in the money and no more than 1% out of the money. And I got to take out the probability. I'm going to leave a 2-point spread. I would never trade these. That's something I forgot to mention in our previous discussion, and I'll mention it in just a moment. I got close, didn't I? Not as close as I wanted to. I'm going to force this to be a little bit more. This has got to be 0 to 5 in the money for the short option, which is dangerous. And that's something I forgot to mention in the first discussion. I'm trying to find that one. I could build it personally, Apple. Good. Apple 180 to 177.5. Okay, that's the bull put. Right? It's a 61.8% return, a net credit of 96 cents. All right. Now what can I do? I can go to the profit and loss chart. Stock's at 179.98. There's my bull put with my risk of 154, monetary requirement 250. And I know I'm going to overpay for it. March 23rd. But now I've got my bull put. What's missing from my equation? This is the put I sold, the 180. So I buy a 180 call. Okay. There we go. Not really what I'm looking for, but again, this is exactly the same kind of numbers we saw. We sort of doubled it. Double the risk of just buying the call outright because of the margin requirement of the bull put. And then I'd use the bull call debit spread to do it the other way to look for those ratio spreads. Okay. All right. Rajiv's follow-up there. Okay, so he says, what would be a good position on Ford? You own 2,000 shares. Honestly, Rajiv, if you have 2,000 shares of Ford and you have a lower cost basis because you've been collecting dividends or rolling it with calls, I would convert it to the married put to the radioactive trade. I really would, right? Because you're sounding like you're planning on staying in it long-term to collect the dividend. That put will give you the expiration protection that you want, I'd look 150 days to 200 days out in time. If forward falls a little bit, pulls back a little bit more, you can always manipulate that put. If it moves up, you can always manipulate the put and continue to sell calls against it. Okay, so if this is a longer term hold, I know my answer bores you a little bit. I would consider using the married put against your 2,000 shares of Ford because that's a large block of potential money that you have at risk. Whether you have a gain in it or not, you can insure it from the unexpected using the married put structure, and you can still do the other income methods there. And then you said, follow-up, do you have any feedback on Robinhood option trading, brokerage free? I've been looking into them just to figure out what the caveat is. They originally started as just an app to lower their costs, and they were piggybacking on someone else, and then they branched out into options, and then they just came out with their options futures. I believe they're coming out with Bitcoin, and they have a desktop version now, if I'm not mistaken, for most of their trading platforms. So they're new. Their claim to fame is they don't charge any fees. They take from the rich to give back to the poor, us, the traders, and so forth, Robinhood trading. I looked into them. I looked at how they're doing it, what their structure is, how they're getting away with the no commission fees and things of that nature. I'm still researching it because I'm not 100% sure on what they do in order to get the money there and to put it into place. I'll have more for you later, I promise, Reggie. Right now I don't have anything. Other than the same things you have. Hey, this looks intriguing. I looked into it, maybe considering it, not doing it yet. Need to know a little bit more. And I also want to see how their volume's going as far as investors coming in and requirements they have for accounts, which I'm not sure if it's anything. I think it was wide open originally for the stocks. I think they have different requirements to be trading options. All right. Siva, been wondering on radioactive married put strategy with TQQ. Is it worth the risk? Well, it depends. If you think it's a good position and you think that is it leveraged up, I hope, if you're bullish on QQQ. If you're bearish on QQQ or bearish on the markets in general, Siva, I think an inverse married put is a good approach. Doing the inverse ETF if you think the market's going to fall because it'll just move up as the market falls and you'll have a profit. TQQ, let's buy 100 shares. And if I was buying a married put today on TQQ, stock is at 183.73. I'm naturally going at least out 150 days. First one's September, 196. With the stock at 183, I probably want the 190, but since this is a leveraged, I'm going to probably end up going, I'd really like the 185, but that's going to be too much. So I'm going to have to go with the 190. I may end up going with the 195. You can see how expensive it is. 7 points in the money, and it's a $31 put option at midpoint. Okay, so we're paying 183 for the stock, another 30 for the far out put, 31.60. That's not bad. That's not as bad as I thought. I was trying to run the numbers in my head, Siva, off the top of my head, and I thought that it was maybe going to be around 15 to 18%, which is out of my bounds. I typically don't like to take a risk more than 7.5% on a new married put. That's my personal goal. Maybe 8% if I really like the stock. This is highly expensive because of the leveraged factors in ultra long, 11.8% risk, which isn't bad, because if it starts to move up, if we get a good bullish spell, you might be able to sell good premium at the 190 strike 2 weeks out, 3 weeks out, or so forth, and start to lower some of this risk of $2,500. Off the top of my head, unless you're expecting a good bull run next 2 to 3 months, maybe even 1 to 2 months, with naturally, there's going to be some hiccups in there, which would really hurt this position, right? The leverage works both ways. But again, if you're expecting a good bull run, this might be okay because remember, your put's going to lose value. But even if it's at the money, even if the stock rockets up to 190 or 195 the next few days, you could still expect the at the money option to be at least 26, right? 25. So if at 190, let's say it gaps up to 192 or 195, 5 points out of the money right now is still $24, $25 premium. Okay, and yes, you're paying 31 now, but even with a $9 increase, you might only lose $4 or $5 on the put. That's about what you'd expect. with any married put position. You still expect to make 50 to 60% of the gain in the underlying, even with the put in place. A lot of times 60 to 70%. So make 7, 8 points, lose 3 or 4 points on the put. That's expected. Is it worth it? You've got to answer that. I can give you my suggestion, and I kind of did, but that's personal preference for me. I don't like to take a risk of greater than 7.5%. If you like the premiums here on the Ultra, if you've been tracking the Ultra, you know how it moves, you know how it adjusts, and you're comfortable with 11% risk, which you know you'll be able to reduce in different ways even if we're within 30 days to 60 days to September expiration, you know you can only risk 11% on this, okay? The risk is if there's a 5 or 6% correction on QQQ, this is going to drop, what, 12 to 15? And you might be closer to the max risk here at 11.8%. Might be adjustments you can use then, but is a risk of 11.8% of your investment of $21,000 or $40,000 if you do 200 shares, $2,500 maximum risk, is it worth taking that in your personal portfolio or on a single position? You have to answer that. I can't. But because it's leveraged, the risk's only 11.8%. It's more than I would like to take, but it's still out to September. Good amount of time. What was it, 190? I'm sorry, I forgot. 196 days out in time with a max risk of 11.8%. You have opportunity to do different adjustments between now and September. Okay? So, not the risk I would take, but you've got the opportunity there. Yeah, of course, you're going to think of doing adjustments. I know you wouldn't just leave this alone and let it rise. You're giving yourself that time so that you can make the adjustments, of course. But yeah, I'm saying if you're asking me about this because you think it's a good moving one, and you've probably looked in the future or looked at the chain and said, look at these premiums here, $4 for an at-the-money call. You can go up to the 190 right now and still get $3 to cut into that risk. That's some rich premium because of the volatility. Dangerous to just sell a call on this type of security, though, because I could sell the 190 call, get $3 right now. Come Friday, the stock could be at 210, 215 because of the leveraged movement. It's harder to catch. You might be overpaying to buy back that call and roll it to another strike without getting the benefit back. So you plan on doing adjustments. You just have to be careful of the timing because it can get you into trouble there. With the movement works both ways. Hey, great premium because of the movement, but if I try to sell a call to take advantage of that great premium and it moves up because that's what it does, now I'm kind of handicapped. Not handicapped, but I've sort of handcuffed myself and capped the gain to the upside, what we talked about earlier. Oh, and why wouldn't we just do a covered call when we were running that comparison on Amex? Because, well, we wanted to leave the upside open and have low risk. And a covered call didn't solve those problems. It didn't solve that solution. All right. Now, ladies and gentlemen, I think those are all the questions that we had come in. Right at 6 o'clock, as I mentioned, these have been taking that long. It's usually because it takes me 20 to 30 minutes. And I'm not saying that's a bad thing, but the planned material that came in via email at the beginning usually takes me 20 to 30 minutes to get through, and then we still spend an hour to 45 minutes on the questions. Today was about 45, those that came in via email and those that came in live, which is perfect. I have no problem staying on until 6 o'clock, but it seems like we're hitting that target more and more every Friday, but I'm perfectly fine with it. Just remember, if you haven't done so yet, make sure you take a look at the PowerOptions suite of tools. You can just go to www.poweropt.com, put in your name and email address, and of course, start your 14-day free trial. No credit card needed. You'll have full access to the tools, all the ones we showed today plus more, without any credit card information required. Our subscription services after that start at $40 a month for the end-of-day updated data. We also have services for 20-minute delayed data and real-time as well, in addition to our historical data service and for backtesting purposes and the historical option chain. You want to check out other free stuff, other education, remember you can always look at our blog, blog.poweropt.com. We didn't actually look at the webinars page. We have a variety of different strategy webinars, tools webinars, and more. Just go to poweropt.com/webinars.asp, or, of course, you can just click the free webinars tab underneath the main home tab when you're logged into your account. And you can always check us out on YouTube, user PowerOptions as well. Well, as I mentioned, I think I did answer all the questions that came in. If you think of a question later on about today's presentation or something that you wanted to ask today but it didn't get a chance to, or something you just think of later, remember you can email us at any time, support@powerop.com or support@radioactivetrading.com. You can also reach us during market hours at 302-992-7971. And of course, if you're on your trial or if you're a subscriber, you can schedule a coaching session at any time. That's a 45-minute to 1-hour conversation with either myself or Ernie. We'll walk you through the tools on the site, on the phone, answer any questions that you have or more. Well, ladies and gentlemen, thank you for joining me today. I hope you enjoyed today's presentation. I hope you all have a fantastic weekend, and I look forward to seeing you online next week during one of our other live presentations, or if you have other questions that I talked to you on the phone before then. Take care, everyone. Have a great night and a great weekend. Good night.